bear channel, which is a bull flag, and it broke out of the bottom. It tested twice. At this moment, the odds favor an up move first, but there's still that magnet on the 60-minute chart below. Daily chart, this is such a big up move that this is really not that important a bear bar. Weekly chart's another test of the moving average. The market fell below the moving average here, tried to go up, it failed. Tried to go up, it failed. Tried to go up, trying to fail again. As I've been saying repeatedly, that I think the market's going to get a measured move down here before it goes above here. I think that's what the probabilities are. I think if anyone says, "Oh, it's definitely going down," or "Oh, I know it's going up," I have all these years of experience, and I'm such an expert. I know that it's going up, or I know it's going down. The person has an emotional problem. They're just being arrogant. Nobody knows, and sure, anybody who makes a lot of predictions is going to be right a lot of the time. They may be right 50% of the time. Who knows? And they'll keep pointing to the times that they're right, and they'll rationalize the times that they're wrong. To me, in the big picture, I think 60% chance we're coming down here before we go above here. But that's 60%. That means 40% chance that I think I'm wrong, that this will be some kind of wedge bull flag and it'll just go to a new high. Monthly chart, the rally looks stronger, and it could be forming a wedge bull flag over the next few months. I don't know that it will. I don't care. I'm not trading the monthly chart. I've said repeatedly that this spike down is extremely important, and I think so often I hear people on CNBC pretend it doesn't exist. It does exist. I see it. It's right here in front of me. Here it is. And if you look at the chart, it's the single most important thing on this chart. So in the past 10 years, this is the single most important thing on the whole chart. So to pretend it's not important or that it doesn't exist, I think is ignorant. On daily chart, same thing. On fast money, they keep talking about this as the flash crash. They use the adjective flash to somehow minimize it, as if it's really not a crash. It is a crash. Just look at it. It's a crash. That's what crashes look like, and it's real. And to pretend that it's not really a crash and that it's just a flash crash, and therefore not important, I think is foolish. When I look at this chart, just look at the chart. What's the one thing that stands out, far greater than anything else on the chart? It's this huge bar. So in this chart, the single most important thing is this bar. I mean, by far, the single most important thing on this chart is that bar. And to dismiss it with an adjective flash, as if, oh, it just happened in an instant and therefore it's not important, I think is ignorant. I think this bar is real and it's important, and it happened because institutional traders created it. And they didn't create it by accident. I remember they were talking about the sticky thumb thing, that some guy shorted a whole bunch of stuff by mistake. That's not what happened. I did the math on what they were saying, and the number of contracts that had to be traded were not traded, not even close. So that flash crash argument it's wrong. What happened here was very serious and very real, and it was due to huge selling by institutions. It was not due to some little technical issue or some little guy shorting a bunch of E-minis or shorting a bunch of whatever. I think they said J.P. Morgan or something. That's not what happened. This is due to lots of institutions selling very aggressively, and it's a spike down. And when you see spike downs, what usually follows after a spike down? Probably 80% of the time. I talk about it all the time. A channel, and the market is starting to channel down. And at some point, there's a pretty fair chance that the market is going to agree that, hey, it is channeling. It's forming lower lows and lower highs. This is a trend. And once they do, you could have an acceleration to the downside. For example, if this low gets taken out, I could see the market accelerating to the downside. People will start saying, yeah, it is forming lower lows and lower highs. Here's a low, here's a low, here's a low, here's a high, here's a high, here's a high. The measured move down from this trading range is down here, but the measured move down from the spike is down a lot lower. On the weekly chart, it's down around 850 or 860. And, I apologize for sounding kind of angry. I just get annoyed when I see stuff on television that I think is ignorant, and it's being presented as if it's authoritative. If those guys knew what they were doing, they would be making a ton of money trading. And the reason why they're analysts and Carterworth, technician, is because they can't trade. If they could trade, they can make so much money that they wouldn't be doing what they're doing on TV. It's all entertainment. They're on TV because CNBC has decided that they'll make more money if they have more viewers, and if they put entertaining, charismatic, nice-looking, authoritative-looking people on TV, they'll have more happy viewers who will come back every day. But it really has nothing to do with what's going on with the markets. To me, you should watch it only for entertainment value, not for trading advice or ideas on what to do with your money. That should be based upon what you see. And for me, what I see the most unusual bar probably in the past 20 years, since the '87 crash. And to me, that's important. So, okay. I hope everybody has a good weekend.